these two strategies that we have just mentioned, there is a question of, well, what could drive this shift from one corporate strategy of governance to another, from retain and reinvest to downsize and distribute? Well, first and foremost, we have the sort of the ideological shift and the people proposing advocating the new way of governing the corporation. So here we have Milton Friedman, who was perhaps the most famous proponent of the idea that the corporation exists and its main reason to exist is to increase the value of to its shareholders. He said in his book in 1962 that there is one and only one social responsibility of business: to use its resources and engage in activities designed to increase its profits, so long as it stays within the rules of the game, which is to say, engages in open and free competition without deception or fraud. So Friedman is an early proponent of these sorts of ideas. But it's only really in the 1970s, especially in a New York Times article, that he is taken more seriously and really gathers quite a following, or his ideas become much more widespread and popular. So that's kind of at the macro level. But then we have within economics at the micro level a new branch of theory, or these developments in this new branch, which advocates shareholder orientation. This is in the form of agency theory. If you haven't come across the principal agent problem before, well, essentially what it is saying is that the principal is the person who owns the firm, say the shareholders, and the agent are the managers. And there is always going to be a kind of mismatch in the incentives between the principal and the agents. So the shareholders and managers, this is just one example pairing of principal and agent. You could have a different pairing. Say the principal could be the managers and the agent could be the employees. And again, because of our assumption that people are self-interested, we recognize that there will be a problem that when the principal isn't looking, the agent will do what it likes, essentially. When the cat's away, the mice will play. This sort of thinking. So if the owner of the firm wants the managers to maximize the profits as much as possible, but there is only so much the owners can do in order to ensure that the agent does so, well, then you're going to have a problem. Because the agent, in this case the manager, may have different ideas about what the corporation should be doing, right? What its strategy should be. If you view this from the point of view, well, here now in the principal position we have the manager, and in the agent position we have the employee. Well, when the manager hires an employee, the employee says, oh yes, I'm extremely productive, very knowledgeable, I'm always hardworking. As soon as the manager is not looking, the agent, in this case the employee, may start to just simply shirk, to not do their job, to maybe have a little nap while supposedly, constructing whatever they sell, right? So this is the essence of the principal-agent problem. You can't always be sure that the incentives of the principal on the one hand and the agent on the other add up or are in line. They're often not the same thing. So this problem, it was part of the development of this microeconomic theory, which became increasingly influential in the way business is run. So in answer to the question, how do you ensure that agents do what the principal wants? There were a few solutions which then came on to shape the way businesses were run. And it influenced the way corporations were governed. So one solution to the question is, well, you can simply just have the principal monitor the agent and always just see and check in on what the agent is doing. Are you doing your job now? Are you doing your job now? This sort of direct monitoring. The drawback of this solution is quite obvious. It takes up all the principal's time. It's very costly. Perhaps it's not even possible to always be watching all the employees that work for you. The other two solutions broadly fall into two categories, and it kind of goes back to the sort of metaphor of the carrot or the stick. If you want someone to do something, you either whack them with a stick in order to force them to do what you like, or you give them some kind of reward for doing what you would like them to do. So the former being the stick and the latter being the carrot. So in the form of the second solution, what is the drawback? Well, you don't necessarily always have to monitor your employees. You have to monitor a little bit, but as long as you make a threat that is credible, like you will lose your job if you do not do your job properly, then, well, that could be enough to ensure that the agent works in the interest of the principal. But of course, there's still some cost associated with this solution. It involves some monitoring and perhaps some antagonism even between the principal and the agent. The third solution is what we all call the carrot. The drawback of this is, well, you're going to have to use some of your profits basically in order to get the agent fully on board with your interests. You have to make sure that the reward is high enough that it's actually worth the agent, whether it be the shareholder, whether it be the manager or the employee. You must ensure that that reward is high enough. And you also have to have results that are measurable to see that, well, if, let's say, the employee is super productive and creates as many widgets per hour as possible, then you increase their pay in relation to their productivity. If the agent is the manager, say the CEO of a corporation, then the carrot solution is to say, well, when the corporation increases its share price by 20% or X%, then your pay will go up by X%, right? Or Y%. So that's the sort of carrot solution to the principal-agent problem. Now, this line of theory, and of course I'm only giving a very broad overview here, goes into much more detail and determines the conditions under which this happens. But it's all made in the framework of rational, self-interested agents within the model. So it's a very neoclassical approach. And in fact, because it seems to relate to real-world problems, it really motivates the development and application of this theory, which brings us back to our corporate governance paradigm shift. This sort of theory shifts the question of corporate governance into the realm of, well, we just need to align the incentives of the managers with the shareholders, which is most often done in the form of, well, performance-related pay for CEOs. And between managers and employees, well, sometimes it's performance-related pay. So perhaps if you're picking bananas and your manager wants you to pick as many bananas as possible, the manager will say, well, I'll pay you, 5 cents or 2 cents, whatever it is, per banana that you pick. And therefore, that the carrot solution can be used there too. But most often, as we'll see, it's the stick that is offered to employees and the carrot that is offered to CEOs and managers. And we got some data that kind of relates to this. So as we see, managers get the carrot. So the CEO pay has massively increased in the last few decades. Here we have the US and the UK. And we've got the percent change in CEO compensation. So that includes all pay. So whether in the form of stock prices, whether in the form of their salary, bonuses, and so on. And what we see is, well, after the 1980s, CEO pay just skyrockets because we have the increasing influence of this kind of theory. That's, well, you should align the interests of the CEO with the shareholders. The second thing to notice here is that CEO pay is highly, highly correlated with the stock market, essentially, right? We see that it peaks here when the stock market peaks, and that's because what the shareholders have done is to increasingly offer pay in the form of shares. So CEOs and shareholders benefit from a higher share price. Compared to the typical worker pay, the increase in CEO pay, as perhaps you already know, has just, yes, I mean, typical worker pay has been stagnant, relatively speaking. There has been a little increase, but nowhere on the same scale as CEO pay. And as we see here, well, in the UK, just to use a different country as an example, we see a similar story. CEO remuneration since the 90s has increased much more quickly than the average employee earnings. Okay. Now, on the other side, the argument is that CEOs get the carrots, they get the performance-related pay and so on, whereas workers are increasingly getting the stick, which for our purposes is, well, the threats of unemployment if they do not work productively and hard. Now, how can you increase the threats? Well, you remove the fallback option, or the strength of labor within the corporation. And one way of seeing this is to see the effect and strength of unions, of labor unions. And we can measure that at least fairly well with union density, which basically says what percentage of all wage earners or all people employed are in a union. Here we have data for Australia from 1960 until 2000. And we see that around 50% of workers in Australia were in a union up until around 1980, at which point we see this downward trend. A similar story can be seen in Austria. Let's see, France, Germany. We see the effect of reunification here, but otherwise it's downward. Let's see, Italy perhaps. Italy, in fact, increases before 1980 and then slowly decreases. The Netherlands, UK, perhaps we'll just isolate that. Again, increase slightly up to around 50% and then decreases. And then in the United States, well, it was already quite low at the beginning of the sample, but it's gone down to a mere 10% in recent years. So in the countries that we have mentioned, at least, union density has decreased, meaning that workers are less protected, are less strong in the negotiations over pay and work conditions than they used to be, which increases essentially the threats of unemployment, as they have less power in this struggle. So what we can see is, well, this approach of trying to align the incentives of workers and CEOs with shareholders has effectively been done in two ways. We can see that in this case, the workers are in a more precarious situation by some measures, and the CEOs have been kind of, in many ways, brought onto the side of the shareholders by being paid in the same currency as the shareholders. And the next question is, well, if these ideas became popular and were brewing in some sense, as we saw with Friedman since, well, like the 1960s, why was it only in the 1980s that we suddenly see this shift from one form of governance to another, where CEO pay explodes upwards and workers are put under more pressure and their pay and union rights are threatened more than ever? What happened in the 1980s? Well, in the 1970s, we have two major events in the world economy. The two oil shocks, the first in 1973 and the second in 1979, which drives up the cost of crude oil around the world through the limited supply from the oil cartel. And as we see here in the graph, the real price of oil just skyrockets from one year to the next, from 1972 to 73, and then even further at the end of the 70s. So this, of course, with higher costs, as oil is a crucial part of the production of many different goods, this leads to cost-push inflation, and inflation goes up massively around the world. As we see in this graph here, we have Canada, United States, United Kingdom, Japan, I think Germany as well. And we see that, well, inflation in these five main major economies is usually below 5%, even before the 1970s. But then during the 1970s, it just skyrockets. So here we have Japan with 23.2% in 1974, the United Kingdom around the same in 75, and we see that the other countries as well, Canada, United States, and Germany, are also exhibit high rates of inflation due to this oil shock. Okay, so we have high inflation. How does this relate to everything that's gone before? Well, high inflation means that you have pension funds and other investors who may be getting, let's say, 3 or 4 or 5% return on their investments. But now that inflation has increased, these returns are no longer, no longer much at all, right? So their real rate of interest has gone down. It may have gone to zero, it may have gone negative. But this presents a major problem then for those who are managing these pension funds and the investors who are trying to make a return on their money. So essentially this leads then to a form of pressure on lawmakers to help these pension funds and other funds and other investors find ways of getting their usual sort of real high rate of return, which essentially means that the lawmakers are now under some pressure to remove financial regulations and to allow these funds to invest in assets that yield a higher nominal return. The problem with doing so is that the higher nominal return assets are risky. You only get a higher return if the asset is considered risky. So these risky assets, these risky investments, are called junk bonds usually. If a corporation issues debts that is not ranked or rated very highly, then the sort of colloquial term, if you like, for such risky, high-yielding bonds is a junk bond. But due to this pressure from inflation, these two acts in America in particular allowed pension funds and insurance companies and other financial institutions like saving and loan institutions to invest in these junk bonds. This was previously not allowed because, well, the governments wanted to ensure that there is more stability in the system and that there isn't too much money going into these risky high-yield bonds. But now with the pressure that is on them, they have allowed this to take place, allowed these institutions to invest. So with these junk bonds comes a whole new problem. This is the problem of corporate raiders, which were especially rampant in the 1980s. The idea of a corporate raider is one where an investor or a group of investors try to buy out enough of a company, so to accumulate enough of the shares of a company in order to take control of that corporation. And then perhaps with the control of the corporation, downsize it, liquidate it, perhaps sell off its pension or tap into the pension fund that it had going in order to receive a high rate of return on the purchase of this corporation. So this is what's called a hostile takeover, when the board of a corporation says, look, we're sorry, but we cannot accept your bid to take over our company. And the investor or the consortium of investors say, well, no problem. We'll just buy all your stocks or initiate a proxy fight. We'll buy out the main shareholders in your company and therefore gain access that way. How do junk bonds relate to this phenomenon of hostile takeovers? Well, now that junk bonds are deregulated after the stagflation of the 1970s, these junk bonds are used to finance the takeover of a company that is considered sort of weak enough to take over. And I say weak, but some of these corporations were actually quite big that were eventually won over. But how did it work? How can you use junk bonds in order to take over a corporation? Well, basically you get an organizer in a consortium who makes a shell company, just some company that only really exists on paper as an arrangement in order to issue these junk bonds. And when it sells out these IOUs, the consortium basically buy these bonds, collect the money, and well, now in an era of deregulation, the demand for junk bonds is actually higher than ever. And essentially, these junk bonds are only repaid after the finances comes together, the funds are collected, and the company is acquired. And once the company is acquired, you can then start to pay back the junk bonds of this shell company using the cash flow of this new corporation. And that could mean liquidating the assets of that corporation, decreasing costs, firing employees, and really stripping it down, maybe completely shutting it down altogether, which in fact happens, but the majority of the time it was simply tapping into the resources without completely shutting down the corporation. But generally, the idea is to tap into the sort of cash flow of this massive corporation, and in so doing, once you gain the control of the corporation or enough of the shares, you can then install your own shareholder-friendly board, where you agree, okay, these are the goals of this corporation that has now been taken over in this so-called hostile takeover. If you've seen the movie Wall Street from 1990 or so, it's essentially all about this and about how it really came into its own in the 1980s in particular. But you might say, well, that's interesting. Okay, fine. You have these corporations that are taken over in this sort of hostile way. But surely, it's not all corporations that are getting taken over this way. How could such a phenomenon basically lead to the widespread adoption of a downsize and distribute strategy? Well, firstly, those who are successfully targeted, they are explicitly operating according to these downsize and distribute principles. But even those who aren't successfully targeted, and those who aren't targeted at all, well, now they're under pressure to increasingly operate by shareholder-friendly principles, by the idea that the corporation should be maximizing shareholder value as much as possible. Because if they fail to do so, if they're not very profitable, if they're not increasing their dividends and increasing share buybacks, then they will come to the attention of these corporate raiders who will try to use the same strategy to take over such a corporation. So effectively, there are those who are explicitly now operating according to the downsize and distribute strategy, and others are now implicitly under pressure to do the same, and in fact do so. There are other effects and sort of defense mechanisms of the corporate raiders, or so against the corporate raiders. For example, there was the development of these what are called shareholder rights plans, which basically is a defense mechanism which stops such hostile takeovers from taking place. But these were only developed in the years after these first the first batch of corporate raiders in the 1980s. Another way in which you can try to stop corporate raiders from taking over a corporation is to increase the indebtedness of your firm. If your firm has a high amount of debt, is highly leveraged, then it will be less attractive to these raiders because, well, there'll be less to liquidate if they were to take over. So in some sense, there's an incentive to increase the indebtedness of firms that are not going to be taken over by corporate raiders. Okay, so we see through the changes in legislation, largely motivated by stagflation of the 1970s, we see that there is now this movement towards pushing for the financial motives of the firm to be emphasized. So the shareholder value maxim, the shareholder value principle, is installed directly in this case here, but also indirectly through the pressure of these corporate raiders. So to sum up, what have we been speaking about here? And how does this all lead to financialization? Well, let's come back to that definition of financialization that we began with at the very beginning. So here we've seen financialization often means, well, this ascendancy of the shareholder value maxim. The ascendancy of the shareholder value as the mode of corporate governance. But other definitions vary. Some say that, well, financialization actually refers to the growing dominance of capital market financial systems over bank-based financial systems. In other words, this is where, in order to get finance for your investment projects, you don't go to a traditional bank and ask for a loan. You get a consortium of investors, perhaps, in order to lend to you. And in fact, that's what we see as well in this example of the corporate raiders, who essentially organize themselves as a shell company in a consortium in order to take over a corporation. They don't always involve traditional banks at all. Another definition of financialization is the increasing political and economic power of the rentier class. Well, we've kind of seen this to some extent in the deregulation that takes place. This is from the pressure of that class to ensure that, these junk bonds are available. You could also see financialization as the explosion of financial trading with new financial instruments. This is much more relevant for explaining the financial crisis of the 2000s and so on. We haven't really seen that so much here. Krippner in 2004 gave a nice, concise definition, which is financialization is the pattern of accumulation in which profit making occurs increasingly through financial channels rather than through trade and commodity production. So in some sense, financialization is the recognition that profits now no longer are made in the real sector, but in the financial sector. And real corporations or corporations involved in the production of real goods and services now make a lot of their profits in other financial sectors, or are under pressure by the financial sector to increase their profits and their payouts. We have this definition by Epstein, which is perhaps the most widespread one. We won't go into it here because I basically said it at the very beginning. And we have different names. So particularly in our university, there are two names in particular. Professor Evans calls it finance-led capitalism, and Professor Hein calls it finance-dominated capitalism. But essentially it's the same thing, with different emphasis, if you like, on the detrimental effects. So to sum up, what are the causes and effects of financialization? Well, the causes, firstly, there's this ideological shift that is triggered by this acute time of stagnation, leads to financial deregulation, and even changes in the tax code in later decades. As we saw in previous weeks, capital is increasingly taxed less, so decreasingly taxed. And the effects of financialization, just to sum up, well, there's a greater share of finance in GDP. There's a growing finance sector. Falling investments because profits are now no longer rooted towards investments, but rather rerouted towards the investors, so the shareholders. Increased indebtedness insofar as corporations use debt as a way to prevent hostile takeovers. But also the investors are, by issuing these junk bonds, increasing the amount of debt because they're not going to the safer sort of traditional banks. They're issuing their own debts. So we can see this relation between financialization and increased indebtedness, and therefore increased instability. Weaker unions insofar as the shareholder value maximization means decreasing costs as much as possible. Not cooperating with unions, but rather being in conflict with them and in trying to ensure that they are as small and insignificant or as least powerful as possible, which is then associated with less employment to some extent, and overall a rising profit share of GDP or a falling labor share of GDP. There's also a question of, well, is this also a form of regulatory capture? If one small part of society can become so big and so powerful that it could perhaps influence law. Well, on that note of profit shares and, well, labor shares and how labor shares have fallen, let's return to the graph that we saw in, I think, week 2, when we were speaking about inequality. And let's just compare the pre-1980s period to the post-1980s. To just see is there this shift, this change, as we saw in other variables in this presentation so far? So the labor share in our major economies here have clearly stayed quite stable. In fact, maybe even rose a little bit in the pre-1980s period. Here we have Australia. Australia was rising quite considerably, and it was perhaps only Canada that was decreasing prior to the 1980s, although not by much, only a couple of percentage points. Oops. But then if we look at the post-1980s period, well, it's quite clear that it's a substantially downward trend. Apart from perhaps, at least in the UK, the rest of these economies seem to show a falling labor share. So it does seem that the 1980s is this sort of crucial cutoff point, if you like, and that financialization, this increasing role of the financial markets, can be observed in very real variables like distribution and how much the majority of the population take home. Lastly, from a policy perspective, well, what can be done? In some sense, it's quite easy insofar as if we understand the causes of financialization, then the policy implications are to reverse them, so long as we consider inequality and lower investment to be detrimental, which of course they are. So what can be done? Well, we can increase financial regulation and try to ensure that there isn't too much investment going into risky or high-risk assets. We can impose limits on share buybacks. We can go back to the days where buybacks were not such a massive phenomenon as they are today, and decrease the role perhaps for CEO performance-related pay, as it's often based on luck anyway. What else can be done? Well, we can increase the taxation of dividends and capital gains, which would perhaps, firstly address the inequality problem, but also discourage this kind of corporate governance in the first place. Relatedly, and to the same effects, you could strengthen unions, or at least strengthen the role of labor and other stakeholders on the board of corporations. So this is what is called co-determination, when it's not just shareholders who determine the board of a corporation, but perhaps unions and perhaps even other stakeholders that could have a say in how the corporation is managed. And in so doing, the hope is that this maxim that, the corporation is only there to maximize shareholder value, well, that can be scrutinized a bit further, such that the corporations could work for a larger group of people in society and not just the rich. So essentially, that's all I have to say on financialization this week. I will see you on Thursday in order to discuss the paper of Lazarnik and O'Sullivan, which goes into, of course, the same topic, but in much more detail in certain areas. That's it for today, and look forward to discussing these things with you on Thursday. Bye for now.